does that, our projection is you could see silver this year $300 to $500 an ounce. Okay, now much of that should occur within the first couple quarters of that spread breakout, meaning much of it should occur by middle of this year in a thunderbolt tantrum move. But silver is going to beat the pants off of gold. Silver is very depressed to gold. We all know that. It's been depressed for a long time, so that hasn't worked. When we're focused on silver and gold, the key level to watch is the bond market because we know this time around, not like 2000, 2002, which is dot-com bubble. Okay, fine. Simple explain a overdone sector. Or mortgages, 2007 to 9, this family, that family, a lot of mortgages. Okay. This time it's government bonds. They're the Titanics of the world. Ours, the Japanese bonds, UK, you name it. They're all in dire straits. And we know that, and it's not because of just what's happening now. It's been what's building up and building up and building up. Okay. And now suddenly, because of the events of the tariff versus, the war between us and NATO and Europe and so forth, they want to dump everything. You could precipitate a panic where you don't just get a price drop, but you get a real quick couple day, oh my, crash type fear. Okay. You can't have that in the bond market. It's bigger than this. Its stock market doesn't compare to the T-bond market. And it's not just us, it's Japan. We know that. If you slip down now, much below today's low by a couple points, and we won't get more specific, we do with our subscribers, you could precipitate what we call at least a mini panic. And I know that the Fed will intervene because already in November, Williams, the head of the New York Fed, announced, or in a press conference stated, that the Fed was going to, quote, start buying bonds. Why? He said, oh, just because liquidity in the market needed more liquidity. Okay. They can't rally. They also don't go down. Now, suddenly today punched out that recent low in just below 115. We even got below 113 today. Now, we've got some trigger levels that require a few more points. But if you do that, you could get this thing to start to puke. You cannot have that kind of event. Everything else is meaningless if T-bonds start to go down. People go hands in the air. Okay. And same with the central bank. Well, what's the prime beneficiary of the central banks going berserk? Printing money, expanding money supplies, playing games. Gold, real money. Silver, real money. But the technicals that say it shifted into an outperform versus gold occurred in November at the close. By our metrics, we said, okay, game is on, silver's going to launch versus gold. It's now up to 2% of the price of gold. Early last year, it was at 1% of the price of an ounce of gold. So it's doubled in relative value over a year. And if you go back in history and look at where was an ounce of silver versus an ounce of gold as a percent, let's say the 1980 bull market peak when we hit $50, that old range, okay, it was at 6.5%. 6.5. We're at 2. Okay.
Silver will hit $500 this year. This is a thunderbolt move by mid-2026. The U.S. bond market will trigger it. One drop will cause panic. The Fed will print massively. Silver and gold will spike vertically. Miners are next. The S&P 500 could fall 50%. A historic shift from paper to hard assets is here. This is a generational warning.
And in 2011 peak, when we hit 50 the second time, it was over 3%. We're at 2. Our technicals show us that that spread relationship is broken out, and we're likely, think about this, silver's been in a 50-year, half a century dull range, suppressed, whatever. Gold hasn't been. Gold blows the heck out of every prior bull high. Copper's not where it was back in the 1970s, 80s, 90s, 2000. It's 4 times that price. Silver, for some reason, has been contained. Whether that's manipulation or a combination of events, it made a mistake. And whenever markets make a mistake, they tend to compensate for it and quite often overcompensate in a tantrum. This has happened many times in markets. It's not usual, but it happens. Copper did it in 2005, 6. Lead did it in 2007. We quadrupled in a couple quarters to a new reality. Uh, this event that's going on now with T-bonds could help speed that up because it panics the central bank. And if you're an investor and you look at the horizon, what do you got? Do you want to buy the stock market? The world's selling it now. You want to buy the T-bonds? What's left? What's doing well? Well, what your buddy down the street told you 6 months ago that he did, and you didn't do it. You buy silver. Instead, all we're hearing on the internet is let's short it, let's short it. It's over, it's over. I think this surge that we get in the immediate horizon, if those T-bonds slip a bit more, could take silver well past 100, which might be sort of a normal guy's expectation of where the doubling of the old $50 high. And you get a midpoint stumble in this 6 month explosion, which we do expect to get a midpoint fake out stumble. Where's it going to be? Is it going to be at a logical level or at some level it just turns people's heads like $130 or something? These events that are now going on with T-bonds could precipitate that. Yes, gold's reality is this. While silver's been capped in this half a century silly range compared to any other asset on the planet practically, gold hasn't. Gold made a high in 1980, then made another in 2011. They were each eightfold gains from bear low to bull high, higher bear low, next bull high, eightfold gains from bear low to high. Okay. Our bear low is $1,050 in December 2015. Okay. We're only a little bit more than fourfold right now. If we went to eightfold and quote, did it again, in other words, the norm, okay, have another normal gold bull market, like the two we've just had in the past 50 years, you'd be $8,500 gold just to do the norm. And yet we're in a different world now. Like the T-bonds. They're not, they're in crisis mode. They weren't back in those particular times. We're in a different, so just to go to 8,500, wow, you think that's crazy. No, it's not. It's done it twice before. And yet silver is just now taken out its 1980 high and its 2011 high. It's got a lot of catching up to do. And also on that percentage basis, ounce of silver to ounce of gold, it's off the page cheap. And what if silver, again, not only took out its 50-year highs on price and went nuts and went to a new reality, why shouldn't those spreads go up and challenge or maybe take out those highs? 6.5%, 1980, 3.1%, 2011. We're at 2%. And if gold is $8,000, only $8,000, a normal eightfold move, and silver goes to 3% or goes to 6.5%, it's off the page. So that's what we're looking at, and it's not going to be incremental arm wrestling. It's going to be sudden. If there is an asset on the planet that is overly cheap in relation to anything else, including the metals they get out of the ground, it's the gold and silver miners. They are free compared to their historic valuations to an ounce of gold. And when we examine the technicals of, let's say, the XAU index, which is the gold and silver miners index, been around since the 1980s, we plot that history of its relative valuation to gold. We can see a technical breakout level that we're right now challenging that goes back 11 years where it's been confined in this little base at exceptionally cheap relative levels, dirt cheap, like between 4 and 8% of the price of gold. Back in the 80s, the 90s, 2000 through 2008, it was on average 25% of the price of an ounce of gold. And we're now rallying to over 8%. That's how cheap it is. And it's got technical wherewithal to explode up out of that base, meaning suddenly investors say, hey, I want to own the miners. And then when we reduce it down to the silver miners versus the gold miners, we see an even more explosive situation. So as I transition out of leveraged in process, I'm moving more into unleveraged miners because I think that's where the real bang for the buck comes the rest of this year. But gold's up sharply, silver's up even more sharply, and the miners are up. I thought the miners are supposed to go down with the stock market. Remember that? A sharp drop in the stock market, miners go down. Instead, they're up 3 or 4%. Oh, I think you can see 50% or more, but I think it's going to be more layered than a collapse. We think that since 2025, early in the year, February, I think it made its high last year, so a year ago almost. It was just below 6,200 on the S&P. Right now we're trading what? 67 something? Yeah. So we're up, 10% or so above that high peak of last year. I think it's been a topping process since then. Our momentum work, forget the price chart. Price chart made a high, had a sell-off low, then came back and took out the high. So it's been zigzagged either side of last year's price high, down, then up, now headed back down again. We think that's a topping process on price, while momentum has not made new highs. When price came up and made new highs this year, momentum said, I'm not even near the 2025 high. And there's certain levels on price that if you get to on a monthly close during this year, you'll start breaking some of the structures on annual momentum and on quarterly momentum, which are two long-term momentum metrics we look at. And they're not far below where you are right now, but I want a monthly close there. But even when you break those, I don't think it's necessarily anything that collapses. Yeah, sure, you might shed 10 or 20%, but we do that quite often in the stock market. I'm talking about something a la that October event in 2008 where you dropped like 35% in a couple of weeks. I don't think that's on the horizon until you get much further down than we are now. Uh, uh, I don't specify the number. We do that in our reports, but it's not near where we are now. So we could get some sell-off now that could hurt and cause people to lose all the money they made last year, for example. So a whole year wiped out in the first part of 2026, but not precipitous. Dollar is already broken in our estimate. It broke in April last year March of last year at a price of 104.21, closing price that month. We put out a major sell signal, said the dollar is now in a bear. Price chart wasn't. Price chart has been laying for the last, wow, couple quarters on an uptrend that anybody with a crayon and a ruler could go back to like 2008 on the dollar index. Remember, the dollar index doesn't measure the real buying power of the dollar. It measures it versus two other fiats, especially yen and the euro. Okay, euro and yen in that order. They're 70% of the dollar index. So it's one piece of crap versus a couple of others. But price will break it too. So if you see the dollar slip from it's now 98 something, so it's only about 6 points below where we said sell it. And you see it get down and much below 95, let's say. Even the price guys are going to say, "Oh gosh, it didn't hold." And I think you'll assault the old lows at 70, which we saw, a couple decades ago.
Wow.
But that's sort of meaningless because it's like, who cares? It's one piece of paper versus another. They're both degenerating in real value year by year, decade by decade. Its real value uh, is, I've said this probably in an interview before. Your granddad built a house for 4,500. Your dad built one for 45,000. And now if you want to build the median price, it's 450,000. There, degeneration of the currency.
Yes. And you raise a very good point. I should throw out a few numbers just for the benefit of our viewers. When it comes to the money supply, you often hear people talk about
Yeah.
money printing. And when you look at the money supply as measured by M2 in January of 2020, before all of this craziness started, the money supply was 15.4 trillion. Now it is well over 22 trillion. That's an increase of 42%. So to your point, it's not like
Yeah.
that house that you bought for $1 million.
I think it's up near 100% in a decade. Yeah. Yeah.
Exactly. I mean, that's what's
If not
happening. We're
more,
losing
maybe next
purchasing
month.
power.
It may be next month, if the T-bonds don't hold, because they're going to pull out those fire hoses like crazy. I mean, mortgages are one thing.